Okay, so welcome to a couple of videos I put together for Chapter 9, which is Fundamental Legal Principles of Insurance. Okay, so what I'd like you to do is sort of pause the video, copy down this panel, and then press play, and I'll speak through it. And there's going to be numerous panels in this video, so for each one, pause, copy, and then listen to me and throw in some extra details. All right. I will be requesting to see the copy of your notes over this video and the second video after spring break. Okay, so that's going to be the assignment to verify that you've done the work. All right. So fundamental legal principles is what we're going to be talking about that support the insurance industry. And those principles are going to be the principle of indemnity, the principle of insurable interest, the principle of utmost good faith, and the principle of subrogation. So that's going to be the first video. And then we're going to talk about sort of how these ideas are backed up within the legal requirements of an insurance contract and the special characteristics or the distinct legal characteristics that an insurance contract has. Okay. All right. So I'm going to move on to the next panel. All right. So again, pause, copy, and then press play. Right. Okay. So this video is covering these legal principles of insurance. And the first is the principle of indemnity, which we've talked a lot about already. So the principle of indemnity says that the insurer, the insurance company, agrees to pay no more than the actual amount of the loss, right? Indemnification is making somebody financially whole, returning them to the approximate same financial condition they were in before the loss, okay? So this is basically just saying that the insured should not profit from it. All right, so purpose. All right, let's prevent the insured from profiting from the loss. That is not the purpose and point of insurance. And if that was allowed, all it would do is raise the premiums of insurance because the insurers would have to factor in that increased cost, right? And by indemnifying, but not more than indemnifying, it's hoped that we're lowering the moral hazard of having insurance because insurance does present a moral hazard. It provides another way of turning an asset into cash other than just selling it. Okay. All right. Now, there's some, oh, and by the way, inflated claims is moral hazard too. All right, so there's some exceptions to this principle of indemnification that we've also talked about. So life insurance, for example, is a face value contract. If my life is worth $1 million, who knows? But if that's what my life insurance contract states and I die, then that is the amount of benefit that's paid out. That is the claim amount, independent of how much my life is actually worth, whatever that means, okay? It's also true for fine art. And it's also true for sort of a newer area of insurance called parametric insurance, which I would really actually think would be a great final end of the semester project for one of you groups to work on, okay? Parametric insurance basically says it's for property, and it basically says if damage occurs to my building and wind speeds hit more than 100 miles per hour, insurance company will automatically pay me X amount, $200,000, whatever we have specified with the insurance contract, with the insurance company. So damage has to occur and some kind of parametric threshold has to have been attained. Wind speed, flood level, earthquake, some kind of physical parametric thing has to have occurred with damage, and then you write out this face value amount check, okay? So that's parametric insurance. So it's something a group should think about looking into. It's becoming more and more popular. And then there's also some other oddities that kind of violate this principle of indemnity. So I forget who it is, but one of the auto insurance companies offers replacement value of your car if it's like 2 years old or younger. If it gets totaled, you don't just get the actual value of your car when it was totaled, but you get the replacement value of it, of a like new car. Okay, so that's doing more than indemnifying you, right? That's getting you a new car in place of your 1 year old car or year and a half old car. Okay. All right, we're moving on. Let's see how this works. Not too well. There we go. Okay, so again, pause, copy this panel down, then press play and I'll chunner on. All right, so this is the principle of insurable interest, okay? And so what this principle will mean is if you don't have an insurable interest, you're not allowed to take an insurance policy out on that asset, okay? So the insured must be in a position to lose financially if a covered loss occurs, all right? So, for example, I cannot take out property insurance on land or a building that I don't own, right? Because if that land or building then had a loss, it doesn't affect me at all because I don't own it, right? So similarly, I'm not allowed to take out a life insurance policy on someone other than me, my spouse, because Lord help me, if my spouse dies, let me tell you, I suffer financially, okay? Or my children. And that's a little bit of an exception, a little bit of a weird one, but back in the olden days, you know, kids were a good workforce. All right. So if I lose a kid, I lose a worker. In addition, if I lose a child, if you lose your child, you have to bury them. There are expenses that you have, right? So you are allowed to take out life insurance policy on children. Okay. All right. So, but otherwise, I can't insure other people's assets. Now, what's the purpose? If I could do that, then that really wouldn't be insurance, because indemnification is no longer in play here. If a loss occurs to somebody else's property, that doesn't impact me. So now we're in the world of gambling, okay? And in fact, if I have an insurance policy out on like your car, maybe I'm even hoping that something bad happens to your car because then I get a payout, right? So that'd be gambling. So violates this idea of indemnification. And it would also mean that if I had insurance on your car and you had insurance on your car and your car got in an accident, that loss amount would have to be paid out twice, once to you because you got an insurance policy on it, and once to me, so I got an insurance policy on it. So one loss would have double the loss payout. This is not a healthy thing for an economy, okay? All right, and it was also reduced moral hazard because, you know, if I've got insurance policy on your car, then, you know, maybe a couple of your lug nuts get loosened on your wheel one evening, but, you know, mysteriously enough, all right? So if I'm allowed to gamble on other people's property, it increases my moral hazard to hope something bad happens and help something bad to happen, okay? All right, so really vague tidbit here. It definitely comes up that some assets are owned in partnership, okay? So maybe multiple people or multiple companies own a factory or a building or what have you. And so in those cases, all the owners have some kind of insurable interest in that property or asset. So if a loss occurs, the claim is paid out based on the ownership amounts. So if I'm a 30% owner in the building and a claim gets paid out, I'll get 30% of the claim amount, okay? That's why when there are partnerships like this for properties or assets, the partnership agreement will usually state, hey, if there's an insured loss, all that money will go back into into fixing the loss. That way, one of the owners can't say, well, I don't really want to fix that loss. I just want to take my 30% money and go home, well, go off to the Bahamas and have a nice vacation. And I don't want to fix the damage that happened. Okay. So usually partnership agreements specify what has to happen to claim money. The insurance contract doesn't. It leaves it up to the co-owners, as it were. All right. Moving on. All right. So again, please pause, copy, and then press play. All right, so this one sounds pretty wishy-washy, but it's pretty much fundamental to the idea of insurance, historically speaking. It's the principle of utmost good faith. So that states that a higher degree of honesty is imposed on both parties to an insurance contract, both the insurer, the insurance company, and the insured, the policyholder, than is imposed on parties to other contracts. There's really good reasons for this. So think back 300, 400 years ago, you're in Lloyd's London coffee shop. You're either the ship owner looking for insurance or you're the underwriter looking to write some insurance. You had to trust each other. So it was not always possible to prove a ship was lost or to prove what the cargo is, wine, iron ore, silk, cotton, whatever. It might not be able to prove this in London, especially if the cargo is being taken on in India, right? So how do you prove it? So you have to trust each other. So to make this sort of effective, there's some safeguards, which we'll talk about. But the insurer had to trust the ship owner was giving correct information. And the ship owner had to trust that the insurer would honor claims. Like, the insurer, the insurance company could say, I just don't believe this ship owner that they actually have this ship that they claims got iron ore sailing to wherever, Bermuda. But the insured, the ship owner's like, man, if I say my ship's lost, I bet they're not going to pay out because they're going to tell me to prove it, right? So if such distrust exists, there's no possible way you can write an insurance contract, all right? Or you'd even go seek out an insurance contract, or you'd even go pay money for an insurance contract. All right, so we had to have this principle of utmost good faith, and it better have some teeth behind it, right? And it does. Next panel. Right. So you're gonna copy and pause copy. Play. All right, so what are sort of the legal doctrines that help give this thing teeth and help support it? Okay, so these are things that the courts recognize. So the first is representations. Insurance contracts contain statements about the asset being insured. Those statements and that information are provided by the applicant for insurance, the ship owner who wants to insure their ship. Okay, so these representations have to be factual. And if it turns out that they're not, then that is grounds for the insurance company to deny a claim payment. They could say, yep, you've got a loss, but you lied about this part on your application, so we're not going to pay this claim out. And or they can simply, the insurance company can simply cancel the contract. So this requires the applicant to be as truthful as they possibly can, right? And this holds up in court. Okay, the court will side with the insurance company if you lie in your insurance application, if you lie in a material way on your insurance application. Okay. Similarly, we've got concealment. So this is distinct from representation. If the applicant fails to reveal material facts to the insurer that matter, they didn't lie, they just failed to reveal things, then that's grounds for having a claim denied or policy canceled. So, for example, if I've got a glass eye and somehow I get through the Minnesota driver's test, right? I never reveal I got a glass eye. And I go to Progressive and I never reveal I have this disability. And they don't particularly ask, do you have a glass eye on the application process? But that's a material fact. It impacts my ability to have depth perception and be a safe driver, right? So it is a material fact. So if I conceal that, I get in an auto accident and Progressive finds out that I've got a glass eye, they've got grounds for saying, look, you lied to us about the risk level. You didn't lie to us. You misrepresented the risk level you were at, and that impacted the policy that we offered you and the premium we charged you. So we're not going to pay that claim. Okay. All right. And then finally, there's warranty. So insurance contracts will oftentimes contain a series of actions that the insured has to do, or a series of actions that the insured is not allowed to do in order to keep the insurance policy active, okay? And so if the insured fails to do these things or fails to not do these things, then the contract is null and void. So oftentimes professional athletes, when they're insuring body parts, the contract will say, all right, you are not allowed to ride a motorcycle. You are not allowed to go downhill skiing. You are not allowed to, go skydiving. There's various risky physical activities will be denied for those people seeking to insure their body parts, okay? Or for example, if you're a homeowner and you got a branch that crashes through your roof, part of your insurance policy says you have to go up there and put a tarp on it within 1 day to prevent further damage to the inside of your house. So that is a warranty, an action required of you by the insurance company. And if you fail to do that and there's additional interior damage because a rainstorm happens the next day and water pours through this hole, doesn't have a tarp over it, the insurance company can say, look, we're not paying for that additional damage because you failed to secure the property in the way that the contract specified you should. Okay, so warranty is also a way to protect the insurance company. All right, and these hold up in court. And it's a good thing to keep in mind that all of these principles and these legal doctrines, these have been backed up by court cases, and they've actually been developed through court case after court case after court case. All right. The courts ultimately decide what is and what is not allowed in an insurance contract. Okay. All right. Last principle, subrogation. All right, some high-tech graphics here. All right, so I want you to pause, copy this down, get the picture perfect, and then press play. Okay. All right, so subrogation. It's got a weird statement about it, and then I'll try and illustrate through this this drawing. And my apologies, Isabel. So subrogation is the substitution of the insurer in place of the insured for the purpose of claiming indemnity, being made financially whole, from a third party for a loss covered by insurance. Okay, so I am the insured. That's my car. Progressive is my insurance company. Isabel is the third party. Okay, her insurance company is Travelers. Here's what happens. Isabel, driving a minivan for some reason, is hauling butt, and she slams into my car. She's at fault. Terrible, terrible. I suffer damage. Okay. So I need to be indemnified, and I have an insurance policy with Progressive. So, but it's Isabel's fault. So I have two options. The first one is not subrogation. I could file a claim with Isabel's insurance company and say, hey, you're insured slammed into me. You're covering her driving. So you need to cover the damages to my car and maybe my medical, whatever. Okay. Right. So that's one way insurance could work, and you have the right to do that. What subrogation says, though, is that I can just stick with working with my insurance company. Okay. I can say, hey, Progressive, Isabel and her insurance company slammed into me. There's a bunch of damage, but I'm going to file a claim with you folks. Okay. And Progressive says, yep, we understand. So Progressive, indemnifies me, medical bills, auto damage, what have you. What subrogation then means is that Progressive is allowed to play the role of me, and Progressive is allowed to say, hey, we have suffered a loss because of this accident, and Progressive can go after the third party to reimburse them for the claim money they gave me. Okay. So you are allowed to go through your own insurance company. Now, and Travelers then would pay out the claim because, by the way, insurance does cover, and this isn't about Isabel, but this is just a statement in general. Insurance does cover stupid. Okay. If a driver acts stupidly and slams into somebody, that's a covered loss. Okay. So Travelers would say they're on the hook for this, if it was agreed that Isabel was at fault. Okay. The way this really comes in handy is there are people on the road who don't have insurance, though they're legally required to. And in that case, if my only option was to go after negligent driver who didn't have insurance, they don't have insurance, they probably tend not to have a lot of assets because that's why they chose not to purchase insurance. Okay. So that would be really problematic because there would be no assets to go after to indemnify me for my loss. So I can go up to get Progressive, and then Progressive can go after the third party. Many states have various, every state requires you to have auto insurance, but then many states have these funds that help pay for damages caused by uninsured or underinsured drivers. The insurance companies pay into that, which, by the way, basically means we all contribute to that. Okay, but subrogation allows me to work with my insurance company, and then my insurance company goes after the money from the at-fault party and their insurance company. Okay, subrogation. All right, last panel. Oh, all right, cool. All right, so I want you pause and copy. All right, so subrogation's got quite a few purposes. One of them, though, is a way of preventing fraud. If I was allowed to go after both the third party and subrogate, which I'm not allowed to do, I have to choose one or the other, I, the victim. That's to prevent me from collecting money from Travelers, Isabel's insurance company, and collecting money from Progressive, my insurance company. I'm only allowed to file the claim in one spot or the other. Okay. All right. So don't want to pay out twice in the same loss. And it's used to hold the negligent person responsible for the loss, because if I have to go after the negligent person, I don't have a lawyer on my staff of minions. Okay. I'd have to go out and hire a lawyer. Hopefully, the expenses I bring in will cover the lawyer's fees and stuff, but who knows, right? So it makes it easier to hold negligent people responsible because the insurance company has all that structure and infrastructure in place to go after a negligent party, right? And this can help hold down insurance costs because insurance companies are better able to recoup the money from the negligent party. So if they couldn't, that negligent party's risk would have to be spread out to the people who could pay for it. So then your insurance premium would reflect both your own risk and the risk of other people. So they go up. But if we have a way of going after negligent parties, it helps keep the premiums down. Now, it doesn't always work, right? Sometimes the negligent party gets away without paying any of the damages, but it helps. Okay. All right. Now there's some exceptions. Doesn't apply to life insurance or face value contracts in general. Those you have to go to the insurance company that insured the asset. Okay. And then hopefully, obviously enough, the insurance company can't subrogate against its own insured. So Travelers can't pay off my claim or pay off Progressive who paid my claim. Travelers can't then go and tell Isabel, hey, you owe us $16,000 this claim we just paid off. I mean, sorry, Travelers, but that's the purpose of Isabel buying a policy from you, is to cover her acts of negligence and acts against her. All right, that's what insurance is for. All right, one more video.